any user confirming a transaction with crypto wallets, whether they were ledger or not, had their funds at risk. Super scary stuff. Apparently, the way this happened is that an ex-employee of Ledger clicked on a phishing link, which gave the hacker access to introduce the malicious code. A shout out to our sponsor. This video is sponsored by Stellar Community Fund, an open application awards program to support developers and startups on Stellar and Soravan. More on them later. Hello everyone, I'm Camila Russo, the founder of the Defiant. Welcome to Crypto with Cami, where I go over all the most interesting news in crypto and DeFi in the past week. In this episode, we'll be reviewing the major developments of the week of December 11th. Okay, so to start off with markets, we had a bit of a whiplash effect this week. The week started off with a bloodbath, red candles wherever you looked. On Monday, Bitcoin dropped 7% to just over 40K, while Ethereum's Ether also dropped 7% to just above 2,100. Both assets touched the lowest in 10 days. The correction came after Bitcoin and ETH had rallied to the highest since April and May, respectively. So it was due for a correction. There wasn't anything fundamental driving the drop. It was, just traders taking profits, apparently. But after that plunge at the start of the week, markets trended sideways until the Fed rate decision on Wednesday, where rates remained unchanged. And Fed Chairman Jerome Powell said that rates are likely at or near their peak. The majority of the central bank's open market committee anticipates 3 rate cuts for 2024. That, of course, was hugely bullish for crypto and broader markets, prompting a rally. Bitcoin climbed back to 43,000 and ETH touched 2,300, although both assets are trading at below those levels at the time of recording. Even after the rally, Bitcoin and ETH are still down this week, though. Moving on to what was probably the biggest news of the week, was the Ledger exploit. So Ledger, the biggest hardware wallet provider, had a code library it maintained compromised. This code library called Ledger's Connect Kit was accessed by a hacker who was able to add some malicious code to this library, and this code library was used by dozens of dApps all over DeFi. The attacker was reportedly able to make about $500,000 of this attack, and their wallet was blacklisted by the Tether issuer to hopefully recover some of those funds. So what happened, as mentioned, the attacker infected Ledger's Connect Kit with malicious software in a so-called supply chain attack. The code library was used by dozens of dApps to facilitate the interaction between user wallets and the dApp's interface. So any user confirming a transaction with crypto wallets, whether they were Ledger or not, had their funds at risk. Super scary stuff. Apparently, the way this happened is that an ex-employee of Ledger clicked on a phishing link, which gave the hacker access to introduce the malicious code. This is not the first time that Ledger has had a security breach or issue. In 2020, its entire customer database was leaked. This year, there was also controversy around a software update that was criticized for exposing user privacy. So I think the kind of unfortunate takeaway of all this is if user funds across crypto can be put at risk just by interacting with a dApp because a former employee of a company clicked on a phishing link, it shows that we might be farther from mainstream than we anticipated. I mean, something like this just cannot happen in, the global financial system. More bad news. Senator Elizabeth Warren's anti-crypto bill is gaining momentum. So as you probably know, Warren wants to crack down on crypto, specifically crypto where it involves illicit activities. And this week, her Digital Asset Anti-Money Laundering Act has gained support from 5 additional senators, including 3 members of the Senate Banking Committee. So the bill aims to curb crypto use in money laundering, drug trafficking, and sanctions evasion by increasing regulatory oversight. But the issue is that it doesn't really only address illicit use of crypto, it just cracks down on crypto in general. The bill proposes extending know your customer requirements to digital wallet providers, including non-custodial wallets, miners, validators, and other network participants. Anyone really participating in blockchain transactions. So it's just super far-reaching and imposes requirements that non-custodial and decentralized open source software just simply cannot plausibly comply and perform. So if this bill passes, it has the potential to effectively ban crypto, or at least greatly limit it in the US. Of course, not to be alarmist here, this is just a proposal. It's a bill that is far from getting passed, but definitely something to watch. Now, to move on to more exciting, or at least happier topics, there's this mashup of AI and crypto. Tokens at the intersection of crypto and AI have now a market cap of over 9 billion. And Owen, for now, one of our writers, has a great feature here exploring whether these 2 words are just being put together to generate to generate more hype, or whether there's actual substance there. The conclusion was that there is actual substance, that the risk that many are seeing in the rise of AI is that this could give way to hugely powerful centralized companies. And so a decentralized version of artificial intelligence would be more beneficial to society. And the way that that crypto and decentralized AI startups have an edge is by focusing on compute. So give this story a read. Super interesting stuff. Some of the largest AI tokens to be on the lookout are Tau from BitTensor, Render, and FET. Those are the 3 largest projects in this space, but lots of activity happening in AI crypto as well. Now moving on to protocol and project updates. So GFX Labs is bringing Uniswap to Bitcoin. So GFX, which develops DeFi products, will be deploying trading platform Oko to Bitcoin sidechain Rootstock. Oku uses Uniswap V3 smart contracts to source liquidity and facilitate trades. And so these are the smart contracts that will be deployed on this Bitcoin sidechain. A caveat here is that it won't be deployed using actual Uniswap branding, so you won't see, pink unicorns on Bitcoin yet, but it's still a big move. Uniswap, of course, is a flagship Ethereum DeFi protocol, and now its contracts are live on Rootstock, a player in the Build on Bitcoin movement, which has been gaining traction all year, as we've been covering with ordinals, BRC20s, and smart contract platforms like Stacks. Another protocol update is from LayerZero, which launched its V2. So LayerZero is a cross-chain messaging protocol, and it launched its V2 upgrade across more than 40 blockchains supported by the protocol. The revamp release will focus on streamlining third-party development, bolstering security, and improving throughput. LayerZero's V2 announcement follows a big year for the project. In April, they raised $120 million at a $3 billion valuation in a Series B. And a reminder that last week, talking about tokens, a reminder that last week LayerZero announced plans to launch and distribute a long-awaited token in the first half of next year. So airdrop opportunists are looking at ways to interact with LayerZero ahead of this airdrop. And I'll be going more in depth into this in a little bit, so stay tuned for that. Another interesting protocol update is that activity on Linea has really spiked. So Linea is a layer 2 network launched by Consensus, and activity there in terms of daily users and fee volume is surging after it started its Voyage campaign. So transaction throughput on Linea jumped to a new all-time high of 15 transactions per second, according to L2Beat. And the network ranks as the second most active L2 this week. So here, if you're listening to this episode on video, you'll see how Linea just shot up above its competitors, Optimism, CK Sync, Arbitrum, and so on in terms of transactions per second. The jump in throughput also drove transaction fees to an all-time high, more than tripling those of its rivals. Again, if you're on video, you'll see the really crazy chart there, how fee volume just surged for Linea. So Voyage is a 2-month campaign designed to drive adoption and liquidity on Linea. It's offering non-transferable soul-bound XP tokens as rewards to users who complete specific tasks, such as engaging with particular DeFi protocols on Linea. Of course, with users participating on Voyage with the hopes that XP could qualify them for a future airdrop, it remains to be seen whether this activity is sustainable. And that segues very well into our next news of the week, which was Rainbow, the non-custodial wallet, announcing points. So Rainbow on Wednesday announced a point system rewarding past users and incentivizing MetaMask users to switch in what it called a fox hunt, of course, alluding to MetaMask's fox logo. So every Ethereum user gets points, and it also considered historical balance on Rainbow, swap activity on both Rainbow and MetaMask, bridging activity on Rainbow, and holding Rainbow NFTs. But those who import their MetaMask wallet to Rainbow gain up to 150,000 extra points as long as they used the MetaMask swap feature in the last year. And the scheme was working with the number of users who had previously used MetaMask swap feature using Rainbow. So that number spiked to over 2,000 users using Rainbow after using MetaMask, from just under 100 in all the previous few weeks. There's a Dune Analytics chart that just shows how users who are switching shot up. So these point systems are really working out for Rainbow. We'll see if this activity can keep up and if those new users that Rainbow is attracting thanks to the system stick around. Another token related news is that Seam was the first base token to launch on Coinbase. So Base is the layer 2 network launched by the exchange Coinbase. Seam is the token of the Seamless protocol, which is a lending protocol forked by Aave. And it got snatched the milestone of being the first token to list on Coinbase. So this token launch also came with an airdrop, and it also came with an announcement of a liquidity mining program. So again, more token rewards being announced here. Users of Seamless will be rewarded with Seam tokens for providing liquidity and using the protocol.
Need funding for your blockchain idea? The Stellar Community Fund is funding projects with up to $100,000 in XLM per project to build on the Stellar network. To get started, head over to communityfund.stellar.org and make a submission.
Now, we've covered different protocols and dApps giving away tokens. Synthetics is going on the opposite direction. Super interesting. Synthetics, synthetic asset trading platform, said that it will put an end to SNX, to the synthetics token inflation. So synthetics token holders passed the proposal SIP 2043, ending the issuance of rewards in the form of newly minted SNX tokens. Moving forward, synthetic stakers will exclusively receive rewards in the form of trading fees, with the protocol set to introduce a buyback and burn mechanism once its Andromeda upgrade is deployed on Base. So this is really interesting because Synthetics was among the earliest DeFi protocols to use inflationary rewards mechanism when it was introduced. When it introduced SNX incentives to bolster liquidity back in 2019. So it's credited to actually have invented yield farming by just introducing SNX token rewards so early on. So the end of SNX rewards is really a milestone in the evolution of DeFi. Some projects are looking to cut back on aggressively inflationary tokenomics and token rewards, and instead devise more sustainable systems and more sustainable tokenomics. But of course, as we just saw, token rewards are far from over, and on the contrary, airdrops really do seem to be kicking off at the start of this bull run. And that leads me to my hot take of the week, which is on points. Points are the talking point right now. They are all the rage. It started with Friendtech, arguably. It was one of the first larger projects to kick it off. And now this week with Rainbow, it's the latest, major project to use a point system. But it seems to be, to be starting to become the norm for rewarding users of Web3 and crypto dApps. So what do points do? They give a way to incentivize user behavior without committing to launching a token. It allows for a lightweight way to experiment with user rewards and drive some traction without having to actually launch a token. It also solves some issues with civil attacks, as users are incentivized to keep points associated with a single account rather than have multiple wallets in order to farm future airdrops. So that's all pretty positive. But now projects launching points are definitely on the hook to launch a token later. It's pretty clear that anyone in crypto who's getting points in exchange for doing anything on chain will expect to get a token down the line. So dApps who don't issue tokens after announcing points programs will definitely be letting their users down. And you really don't want to have these armies of when token communities. Many have criticized dApps using points instead of issuing tokens, saying it's basically a betrayal of crypto. Why are we even here if we're creating these points that live on centralized databases using centralized servers, which can be taken away any day and are not really owned by the user? To me, that criticism is not so valid because it's not like points are here to actually replace tokens. They're just being used as a way to reward users, to gamify the dApp experience, rather than actually replace tokens. They're, I think, a previous step to a token and not being used instead of them. But I don't like points for a different reason. I don't think points solve any of the problems that airdrop have and that are, have been around since token rewards have been invented and since yield farms really got popular in DeFi summer, which is they attract fickle users and and activity and liquidity that will just come for the yield and then go away as soon as they find better opportunities elsewhere. Whether it's points or not, degens on crypto will flock to apps if there's the expectation that a token will be distributed in exchange for performing an on-chain activity. Those same users that were farming meaningless engagement will then move on to the next yield opportunity. Points do offer some degree of innovation here in that they are a better way of quantifying this activity that users will be doing as they await the airdrop. There's also this civil resistant element that I mentioned earlier. But other than that, it doesn't really improve the incentives here. And to me, it's pretty sad that we've gone through the entire, one entire new crypto cycle, bull and bear, and we haven't figured out a better way to distribute tokens and to figure out incentives for users. So what do you think of points? Do you like them? Do you think there could be a better way to distribute tokens to actual users of a dApp and not give them, away to airdrop farmers? In the end, as always, it's very simple. If you have a good, useful dApp, a point system or an airdrop will be beneficial because you'll drive users, and because you have a good product, some of them will stick around. But that's all for now. Thanks for joining me, and see you next week for another Crypto with Ken.